I think investing in AI infrastructure today is like investing in websites in 1997. The incumbents usually win. It's customer distribution. The idea of a single person AI company, I think, is like comical at best. I think the venture industry was about to be in for a rude awakening, and then AI showed up. People didn't learn a damn thing from 20 and 21. It's like shocking.
Ready to go? Mitchell, I'm so excited for this. When Nigel Morris messages me and says, hey, you've got to spend time with my friend Mitchell, I'm like, you know what, Michael? You know what? This is going to be a fun one. So thank you so much for joining me.
Absolutely. Thanks for having me on. Nigel's a legend. So.
He is a legend. Always makes me feel very lazy, though. So athletic.
He's also the hardest working man in... I was like, I joked to him the first time I met him. I'm like, well, how's retirement? And then he showed me his Outlook calendar, and I'm like, I think you work more now than you did when you ran Capital One. And by the way, never, ever go on a bicycle ride with him.
I would never. Before we dive into Lead Edge,
Sure.
There was Tiger and there was Bessemer before.
Yeah.
When you think about your takeaways from those experiences that shaped how you operate and run Lead Edge today, what are the one or two that really shape how you think about Lead Edge?
What I would tell you is my time at Bessemer was very formative for why and everything we do here at Lead Edge. So a little bit of context. When I joined Bessemer, this was 2005, Bessemer is this legendary early stage venture fund that is very Shark Tank-esque. And what I mean by that is every year, 1,000 entrepreneurs would walk in the door. And at the time, they had 5 partners. And it was very Shark Tank-esque. And they were wondering why Insight was finding these $15 million revenue companies growing fast that had never raised money. And they were personal friends with the guys that ran, Jeff and Devin and the guys at Insight. And all that Insight was doing was replicating what Summit and TA did, which was hire 22 to 24-year-old knuckleheads, which my now partner Brian and I were, and pound the phones calling companies all day long. And you realize if the company calls you back, the company sucks. It's the CEO you talk to every 2 days for a month. And, and you know how you know what a good company is? Over 2 years, talk to 10,000 bad companies. And so when we got there, a week into the job, they're like, okay, next Monday, you're going to come and present your best companies. And we got there, we're like, oh, we found this great company. It's $2 million in revenue. It's going to be the next Google. They're like, no, it's not. This company sucks. Find us companies that meet 10 million of revenue. And then the next week, you'd find a company that meets 12 million in revenue, but grows 10% a year. And they're like, no, find us companies that grow 50, for them, it's 50% a year. And then you find a company, but it's 20 million in revenue, grows 40% a year, but, has 30% gross margins. And they're like, no, find us business with 70% gross margins. And they had 5, and they over a period of a 6-week time or 8-week time, built these 5 criteria. And they basically said, on Mondays, when we do our pipeline meetings, we want you to never bring a company that meets less than 3 criteria. If it meets 5, you better already have the meeting set up, the next meeting, and start the pipeline meeting with, I spoke to company ABC. It meets X number of criteria. Here's what it does. And so it just was a very rigid framework. In a world where you can call companies all day long and it's an unlimited universe, stay very rigid. And so when we took that framework, we expanded it to 6. Now it's the Lead Edge 8, and that defines everything we do.
I love that in terms of how it defines everything you do, and I love the framework structure. I had Nabil on from Spark recently, and he said that bluntly, this form of spreadsheet investing, respectfully, and I hope you don't mind me calling it spreadsheet investing.
Totally fine.
Okay, is outdated in a world of AI and in the next generation, and that a kind of banker-led approach will not work in the next generation. Is that fair, and how do you think about that? Because I am concerned that that is the case.
Look, we speak to 10,000 companies a year. We have a team of 20, 18 to 22-year-olds. So, 20 to 22. We haven't gone pre-college yet. So you're 22 to 24-year-olds that are speaking to 10,000 companies a year. If I say I need to meet all 8 of these criteria, it's about a 1% yield, which is, tell 10,000 companies, 100 meet all 8 criteria, and to do 5 to 7 deals a year, that's too small of a pond to fish in. You wouldn't end up doing anything. So what we find is if you say I need to meet 5 or more of these criteria, it's just objective. You're 23 years old, Was the company 4 million in revenue or 18 million in revenue? You find about 10%. And this is after speaking to probably 70,000 companies over the last decade. So what a 10% yield, you get 5 or more criteria. We do diligence, so that gets you 10,000 to 1,000. You do diligence on 150 to 175 of them. How do you go from 1,000 to 150 to 175? Most aren't looking to do anything. Because you're calling them, they're not calling you. And by the way, the good ones don't call you back. The good ones you call every 2 days for a month. That 150 to 175 leads you to do 5 to 7 deals a year. In terms of the AI response, and so like we find the companies, 70% of what the stuff we invest in, the guys at Spark have never looked at, they've never heard of. And why? Because they're investing mainly in the coasts. Less than 10% of our companies are in the Bay Area. Not because we don't like Bay Area entrepreneurs. We love Bay Area entrepreneurs. They can build some of the biggest companies in the planet Earth. I just think it's very hard to make money at making, at 100 times revenues, invest in. And so also if you look at our companies, less than 10% are in the Bay Area. 70% of the time we're the first institutional investor. Now, AI and disrupt all this stuff. So when DeepSeek was announced, which I find quite funny that a lot of people that invest in the infrastructure of AI didn't even know about it, because it's like, and by the way, I think investing in AI infrastructure today is like investing in websites in 1997. You and I could have taken $50 million, bought Sun Microsystem servers, and built a website. Today, for £10 a month, we can build a website that's 50 times better than that. Same thing's going to happen. Prices are going to plummet. But the stock market actually acted pretty rationally that day. What happened? NVIDIA stock fell. The software stocks went up. So why do I mention that? We're investors in a company in Toronto that we own the business called Gravity. World's most boring company. It makes budget planning software for small local governments. If you are the water district of Atherton, if you are the Palo Alto Police Department, you need to post a budget online. It helps you plan the budget, post it online. It's a roughly around a $10 million business, grows very nicely, had never raised capital. Before we came in, had never had a salesperson. We came in, brought our new CEO, brought our new CRO, partnered with a guy who had built a $200 million GovTech business. My point is here on the AI stuff, they have, 10 software engineers, 12. They can use companies like Cursor, Copilot, to help their 10 engineers become like 30 or 40 engineers. And you're going to see this at Salesforce. You're going to see this at Workday. The incumbents usually win. Since the iPhone came out in 2007, 2006, whatever it was, there's only been 3 companies built that did not exist before that were $100 billion companies. ByteDance, Pinduoduo, and Uber. Who won? Facebook, Google, Microsoft. Incumbency wins. It's customer distribution. The idea of a single person AI company, I think is comical at best.
Which is why, unpack that, because everyone is saying, hey, we're going to have billion-dollar companies with one person.
It's like these software companies are not as you run an awesome venture fund. A lot of the software stuff isn't that. It's not that complicated. This is not rocket science tech that people are solving. It's sales. It's distribution.
It's GTM. It's regulation.
Yes, it's go to market.
It's
exactly.
difficult.
It's that kind of stuff. And if I had $1 for every time somebody had said to me oh, Microsoft's just going to do this, I would have never invested in any software companies, and nor would anybody else have. But the great thing is it's people ask us, they're well, you must run out of companies to call. Every Monday morning, new companies come in that we've never heard of. That this is software. When Josh Kushner said it 10 years ago that software was eating the world, I was I just kind of this sounds crazy. But he's right. It's changing every sector and every industry. And I believe, I could be totally wrong, but when you look at technological trends over the last 50 years, people always overestimate it over the near term, and they always underestimate it in the long term. AI is going to completely revolutionize the world over the next 10 to 20 years. But it's not going to be because we create a new call center software company. There's going to be some type of company that AI is enabling that nobody else could do something before, and that changes it. And it's going to be guys like you or Benchmark or Sequoia that find that thing at the very early stage. And my guess is it is not just some infrastructure software company that the world knows about right now.
I completely agree with you. I just want to take it in turn because you mentioned Gravity, this company. You said 10 million ARR.
Yeah.
I'm just intrigued because it's a very different world to the one I actually inhabit, honestly, Mitchell. What does that deal look like? in terms of price?
So we are able to buy businesses. So we are able to buy bootstrap companies at, I think we bought the business for like $50 million or something like that. We own the company. Like we bought the business for $50 million. And by the way, it grows like 50, 60% a year. Now, by the way, it will never be an IPO. In a million years, it will never be an IPO. We want to build a business. So I'll give you an example. We just sold a company, and I don't want to talk about returns on here at all, but I'll tell you like what size. There was a company called SafeSend that makes, it's like a verticalized version of DocuSign for tax returns. There's a bunch of reasons DocuSign's not very good at it. It also is like the tax organizer that people get that, like, did you get married this year? Did you have kids? Did you move? And all this sort of things. When we invested, we bought about 60% of the company in 2021. My partner Nime did the deal, and my partner Brian. That business, we met through cold calling. It was based in Ann Arbor, Michigan. It was a bootstrap business that had never raised capital. It had been around for 6 or 7 years, and it was COVID enabled. And what do I mean by that? Well, it turns out before COVID, a bunch of people used to literally go to their accountant's office and sign their tax returns. Sounds totally insane. But after COVID, you couldn't do it. During COVID, you couldn't do that. So it was all electronic. But then it turns out it stayed COVID enabled. Unlike a virtual events company like a Hopin, where people during COVID couldn't go to events, they went to virtual events. It turns out that people like to go to Vegas and drink beer and get away from their husbands and wives and children. And so everything went back to Vegas in these events. You'd never have gotten a DocuSign and said, "Oh, I'm sorry, please send me a paper copy." It's like the reverse. So this thing was cool. So we invested in that business. It was about 13 of ARR. It was growing about 50, 60% a year. It was a controlled deal, so we were buying 60% of the company. And we bought 60% for about 90 of equity and 20 of debt. So what is that? I don't know, 130, 140 million valuation. In 3.5 years, we built the business to about 47 million of revenue and, very nicely profitable. And we sold it to Thomson Reuters, for a great return. It was publicly announced what it was. And that was a business that if you had read our investment memo, in the word IPO would not have come up in the thing. We were like, listen, we'll grow it from 13, 14 million to 60, 70, 80 million, and we'll sell it to a mid-market private equity fund because it's got 90+% gross dollar retention, or we'll sell it to a strategic. If that deal, so we paid, 130, 140 for it, middle of 21, insanity, right? Had that deal, been backed by Benchmark, like Vishria or Peter Fenton, one of those guys, backed at Benchmark, doing a minority deal based in Silicon Valley, it would have been $500 million.
Yeah.
And so let's go find stuff. We don't have to play the same game. Let's go find the boring stuff that's not going to be the next. There's 0% chance it's the next Snowflake. It's the next Datadog. Let's go find stuff that we can just build, invest when they're $10 to $20 million revenue software businesses and exit them when they're $60 to $80 million software businesses. If I talk to
the immediate response would be that yours aren't generational defining founders.
100%, correct.
Me, Fenton, Vish would be like, no, we have to back founders who reshape categories, like true visionary innovators. And here you're talking about a control deal where you're bringing in a team, which is amazing, but a very different scenario.
That's totally fine. I don't have to, we have these 8 criteria. Some of them are generational companies. Look, we've been, late last year we were buying ByteDance. We were paying 5 times earnings for it. It grows 25, 30% a year. That's probably a generation. It's already a gigantic company. But it's just, do you meet the framework of what we do? We own a business called Exagrid that was started in 2002. We own about a third of the company. It last raised money 15 years ago. We bought out Lehman Brothers. It's a $165, $170 million revenue business that competes with HP and Dell in storage devices. It's a 70% gross margin business. It did 26 million of EBITDA last year. We bought our stake at a $130 million valuation. Great, I'm going to build it into a $250 million revenue business doing 70 of EBITDA, and I'm going to sell it for 10 times EBITDA and make 4 times my money. No, it is not generational game defining, but it is tech investing, making really good return, making like good returns.
So I am really worried because we're seeing this shakeout now. I'm getting old. I think you said I was 32. I'm 28, Mitchell. Just to clarify that.
No, I meant the guy from Spark.
Oh, thank God. I was like, Jesus, I'm not that. But I'm really worried because we're seeing this generation of SaaS companies now that's raised a lot of money, but actually they're not profitable. Growth is in the mid-teens now, yearly. Like this is 10 to 20% growth. And revenues of 50 to 200 million. They are not big enough for PE.
Living dead.
What happens? Like, teach me.
Yeah. Fundamental problem that happened. We saw this, by the way, at Bessemer. When we were at Bessemer, Comical companies. Back then, you would basically exit a company through an IPO or a strategic. Those were like the two options on how you could get out of a company. And if the strategic didn't show up, and if you got it to like 50, 60, 70 million revenue and stopped growing, you'd be like, well, then what the heck do I do? So, and in 2010, 2008 timeframe, the mid-market private equity firms like Nautic Partners, GTCR, Charles Bank, they would buy industrial companies, manufacturing companies, services companies. Some bought consumer, some bought healthcare, none bought software. And that was just as like the Vistas, Tomas, and Francisco's were like just starting to start. Fast forward today, now have these big software private equity firms that have gotten very big. And you also have mid-market private equity funds that, where, by the way, these portfolios, they still buy industrial companies, manufacturing companies. Their portfolios grow at like GDP plus 2, right? So if I bring up a company growing 15% a year, like they think that's like really fast for them. And now it's not 100%, but 50, 60% of these mid-market private equity firms also buy software companies. Like they have a sleeve to do software. So now if you like look at all of our exits, a third of our exits have actually come to private equity. In those companies, by the way, I've got some in our portfolio. Don't worry, we did some real stupid stuff in 2022, 2020, and 21, as everybody else did as well.
No,
Exactly, none. You'll have companies that have 130 million of revenue, that have 18% growth. They don't burn that much money, but they have $130 million of cash. Like these companies effectively went public. When in 2015, 17, when companies went public, they'd raise 100 to 300 million. Okay, forget the Ubers and Facebooks and stuff like that. But most companies raise 100 to 300 million bucks. In 20 and 21, they would go raise 100 to 300 million dollars. These companies completed IPOs. You have to get them to. I mean, like we've just like drilled in a couple of our companies that we have this. It's like you have to get to Rule of 40 because that's the only way you're getting out. A strategic's not going to just come and buy you. This company's never going to go public. You need to get it to Rule of 40 to try to either to sell it to a private equity fund. Like, and by the way, I'm sorry, the last round was $3 billion. You're 120 million of revenue, growing 18% a year. If we can get it to Rule of 40, you might be worth 5 times revenues. Like, and again, you can try to pivot all you want. There are so many VCs that just like to like waste their time on company boards. We do not understand it. We're just like, listen, yes, we have a pref, so we would get our 1x. But if you told me today I could take a 0.7x just to get out of it, I would happily cut you. I would happily do it. There are hundreds of these companies out there. The problem with the IPO market is actually totally fine. If you look at IPO performance of companies, they've actually done pretty well versus opening day prices. Look at Reddit's, look at some of these other things. The issue is like the good companies, the Grafana Labs, the Databricks, like they have so much money. They have so much cash. The Stripes, they don't need to go public. And then you have this whole other sector of companies that can't go public.
I'm going to make a contrarian statement. I do not think in 5 years the majority of companies that could go public will go public. I think being public will be an unfortunate consequence of scale.
And that's really bad for the venture capital industry and LPs.
If we don't have a very developed or mature secondaries market.
Correct. That is like very, do you think guys like Don Valentin or Mike Moritz or this John Doerr, they would be like putting guns to these founders' heads today and be like, you need to go public. Don't be afraid of the 27-year-old HBA, Harvard Business School analyst. You'll be fine. We actually think it makes companies better. Like, I get both sides of the trade.
How does it make them better? You know, John Clausen said the other day, listen, if you are a public company or if you're a CEO and you think that having an analyst at Goldman saying, oh, you need to improve your margins is going to increase the discipline within your company, then you clearly do not have a great company.
Look, there's two sides of it. Look, nobody says you, by the way, have to be a public company. Chanel, Tetra Pak, Amway. There are big private companies, Coke Industries. You do not have to be a public company. But I do think if you take venture capital money from people, you should be very clear on. Like, I think the Stripe guy, I don't know him, but like the Stripe guys, I think very early on were saying, like, we don't want to be a public company. So, like, if you invest in us, just know that we very well that be public. I think if you're very open and honest with your investors, I think that's totally fine. Where I do think there are two different ways. I mean, obviously, the quarterly cadence of public companies is a little bit nonsensical. However, I think if you go ask a lot of like Mark Benioff or like, the Google guys, did being a public company make them more disciplined? Did it like make them like prioritize one thing over another thing? They probably would say like, but it was a necessary evil. They had investors that wanted liquidity that they needed to get out. I do think like a company like Zoom went public because they're it's a very profitable business growing fast. They went public because public companies they compete with were constantly like, well, Zoom, it's a tiny business. Like, why do you want, like they use it as a negative where you can be like, okay, go look at our balance sheet. But like, I do think the quarterly cadence is a little bit ridiculous. But there are some companies also that just don't care as much about it, and their stocks are going to be more volatile. And like, we have no problem with companies that go public and want to have dual class listed stock. I've got one in TransferWise over here.
Do you think that private market investors, venture investors, are advantageously positioned because of asymmetric information and historical information to manage the book once it goes public? In other words, is roll-off in the Evergreen Fund the right structure, or do you think it should be handed over to LPs and they are as well positioned?
So I believe it depends what you tell your LPs your mandate is. I believe most private market investors are very good company pickers, but they're not. But like good company and good investment are two very fundamentally different things because of valuation. And when you're a public company, you can know on off. If you are an early stage investor, when your company goes public, you should get off the board and sell the company. Because I suspect that's what you've told most of your investors that you do. You spend all your time picking small companies, grow them into big companies when they go public. Just get off and call it a day. Look, we are relentless in our focus of trying to make like 2 to 5x in 3 to 7 years. And when we do it, just like move on to the next company. Now, again, our business is not like the early stage venture business is a lot of like trying to get 100 baggers, but you're gonna have a bunch of zeros as a result. That's just not our business. And like we just feel like if you can cut the downside scenarios of the zeros, you can generate like really good returns. Like, look, people have always credited us with like very high like DPIs, and it's just a relentless focus on selling. Like, I know this. When I sell, I'll always either sell too early or too late. Have I regretted selling too early? Yes. I've never regretted like too late. Like I just think pigs get slaughtered at the end of the day.
I'm so enjoying this. A relentless focus on selling. What have been your lessons from a relentless focus on selling, and what does that really mean?
Relentless. So we have a disposition committee at LeadEdge. And we meet like...
What is a disposition committee?
We look at the portfolio and we say like, hey, how is the company doing? But by the way, what's an investment committee? An investment committee is you sit and talk about companies that you want to invest in. You like analyze, should I invest in this company? Well, a disposition committee is the exact same thing, just in reverse. I'm already an investor in this company. How should we think about getting out of the company? Oh, there's secondary. Can we find secondary? Is there an early investor that might want to buy more of our stake? Is there a crossover hedge fund that would want to buy our stake? Why might we want to sell? Because the company, we think the market size could be too small. We've lost confidence in the management team. There could be a whole host of reasons. But it's like, we think there's a lot of really good funds that are really good at investing. We think there's a lot of people that are not very good at selling. By the way, I might blame LPs for this just as much as GPs. Like the LPs have to like hold the GPs accountable. One of my longtime LPs refers to some people, like some VCs, as pigs at the trough. It's like, well, I ate the food, I like spent all the money. Now give me more money to spend again. And like they couldn't give you the third or fourth time if you haven't given a lot of the money back from the first or second time. There's just a lot of like, I think a lot of people in this industry are very complacent. All of us as GPs need to do a better job getting money back to LPs and figuring out how to do it.
So You said there about disposition committee,
Yeah.
and then I want to talk about like venture's place in a money manager's book because it's
Yeah.
going to be too interesting. You said there about disposition committee. I'm often told that companies are bought, they're not sold. Do you agree? And how do you reflect on that bought, not sold as a sentiment?
You have to, well, in order to get, look, I've had lots of returns generated by selling the companies, by putting them up for an auction and selling the companies. There are a lot of things a lot of companies don't do that they probably should do. It's very hard to get bought if your strategics don't know who you are. So we encourage all of our founders to get to know the biggest strategics in the space, get to know the private equity funds that, could eventually buy you. Like, by the way, if you think you're going to do 50 million in revenues this year, up from 30, tell them you're going to do 40 and then beat the number. And it's just building relationships and partnerships with people.
We mentioned there about kind of duration. You said like 2 to 7x in 3 to 5
We're
years?
trying to make 2 to 5x's in 3 to 7 years, which basically blends to a 20% net IRR curve.
Okay, totally makes sense. The thing that I hear there is duration. So I'm a money manager at a big endowment pension fund, and I'm going, okay, with that duration, if we compare that to now a 15-year, what it will be duration for an early stage venture firm,
Yes.
I can compound my money with you 3 times over, almost.
Yep.
Yeah? And get that, say, blended, say, 3x.
Yeah.
Or I can go to a early stage venture firm, which is now probably outsized in terms of just actual size of fund, and maybe get a 3x. Mitchell, I've seen the data. There is not many 3x funds.
By the
It's
way, totally agree with you. By the way, we met some endowments like a couple years ago that said, your lead edge, your fund returns aren't good enough. All your funds aren't 3x net funds. I only invest in 3x net funds. And we left the meeting and we said to ourselves, should we go hire that guy immediately? Like, should we hire him to run our money? Because we want to, please tell me where all these 3x net funds are all run. It's a complete fallacy.
And so my point is, if I can compound my money with you 3 times over and get that, say, 3x blended versus a hopeful 3x in a venture fund over a 15-year period, and this is my point, the duration is so long, how does venture earn its place in a large...
I think it's very hard. I think there's too many venture funds. I think my advice to guys and gals that go start venture funds and start early stage venture funds. And have you ever interviewed, or do you know Fabrice Grinda?
Yeah, of course, I've interviewed him twice.
Yeah.
I really like him.
So Fabrice has been an LP of ours for 15 years. He's a very good friend. Those guys have figured out the game. It's like invest in the seed or A and sell a bunch in the B or C. That is a fantastic game to play. And you can make a ton of money doing it, and you generate DPI back to your investors. You still get to ride your winners, and you're providing both. Like the 15-year duration thing is totally true, and it should scare more. It's actually shocking that that the number of venture funds over the last 5 or 7 years has actually increased, given that the exits are getting longer, not shorter. What I believe emerging managers and people starting venture funds need to do is take advantage of the secondary markets, and the fact that these growth funds have gotten so big, or the crossover hedge funds that want to get it, or the public funds that want to get into private investing, and start selling off stakes. Do the seed, do the A, and sell some in the B or C. But you're not selling the whole position. Just start to return money back to people.
I get you, but then I also think, because I just had a GP on from Emergence, and he basically outlined the different fund returns they had they sold or not sold positions. And bluntly, they sold their Salesforce position at IPO, and had they not, they would have made another, I'm butchering it, but 20 to 30 billion in gains. Bessemer sold their Shopify position at IPO, lost billions. My point being there with your mention of Fabrice and selling at the BC, sure, but actually, if venture's a power law game...
That's true. Yeah. So I take it, but by the way, you got to stay in business. And so I think the faster a venture fund can get to if you could get a venture fund that could get to a 1x faster than other funds, that fund could probably grow assets quite a bit. And I'm also talking towards emerging managers as well, who need to stay in business and need to raise funds 2, 3, 4, and are not people like Bessemer that have been in business 80 years. And by the way, for every Shopify, go ask them about 1999 and 2000, or how many billions of dollars were lost in 2021 by not distributing positions.
You said about stupid stuff in 21, 22. We did, obviously.
Everybody did.
What was your most stupid, and what do you learn from it?
Our stupidest mistakes were just like overpaying for a couple of companies, assuming the exit multiple was going to be like higher than it actually is. Like, and look, I credit my partner Nime, who's been with me since the beginning, with really in like 2018 or 19, we really started to shift our business away from Silicon Valley based companies and needing to say every company needed to IPO. It was go find these gravities, go find this safe send, go find,
What caused that? Because I go through your fun ones, dude, and it's like your Alibabas, your Spotifys, your Ubers, fantastic companies, but all venture.
Yeah. What caused it? It was caused by the fact that we looked around and said there's no possible way that every one of these companies can grow to be as big as they are. Like the law of compounding when you're investing over $1 billion or $2 billion of revenue, or sorry, $1 billion or $2 billion of valuation. It's just like harder. It's just like the law of large numbers. And we also just looked and we're like, who's got money? Mid-market private equity funds. And there's hundreds of them. And we were like, none of these guys used to buy software companies. They're now starting to buy software companies. So now we have like a fertile ground. And if you think about a lot of these mid-market private equity funds, their portfolios grow 7% a year, 6% a year, top line revenue growth. Industrial companies, manufacturing companies. Now they have sleeves to buy software companies. Oh, wait a second. For us, we'll go buy a company that's 30 million of revenue, 20 million of revenue, growing 40% a year. Let's grow it. Let's 2 to 2.5, 3x the revenues, and then it'll be growing like 15% a year. That's like fast and we can run an auction. We can sell the business, and we'll get 20 people that bid for it.
So this is my point. So actually, those companies growing mid-teens with 50 to 100 million in revenue, there is an exit for them.
There is. They just need to pivot the business and realize they're not building the next Datadogs and Snowflakes, and they need to get them to Rule of 40. And the most important thing getting the Rule of 40 is high gross margins. If you have high gross margins and you have 90+% gross dollar retention, it's shame. I mean, you can let the private equity firm, you can try to sell it when you're losing money, break even, or what some of these growth equity firms and venture funds should do is do it themselves. Like, it's not that complicated. Like, it's like, look, you have high retention rates. If you have low retention, like, good luck. If you have 70, 75, 80% gross retention, it's much harder. But if you have a 90, 95% gross dollar retention business, like, make the hard decisions, and get the thing to profitable. Turn it into Rule of 40.
So you said, hey, one of the mistakes was we paid up for things a little bit too much. How do you determine between a stretch on price and a mistake that we stretch too far?
We build a 5-year model. The model's wrong. We try to put a reasonable exit multiple on it, and then just...
Is that valuable to do? And what I mean by that respectfully is like exit multiples vary so much over different durations. If we look back at 2021, 22, the multiple would have been so much higher versus today so much lower. I don't know where
I think you need to use like some reasonable, I think for software, again, revenue multiples of software companies are just shorthand for EBITDA. Like, it's not, at the end of the day, I think you should assume if you build a software company and you're in it, and it's growing, you should assume an exit of it's growing 15 to 30% a year, and that should trade somewhere between 4 to 7 times revenues. Like, yes, like we tend to, like, I think our bands that we tend to assume most exits at are like 4 to 8 times revenues. Like, maybe sometimes 10 times at the absolute highest if it's like growing 30, 40% a year. By the way, I credit the guys at Iconic, like, a huge amount, because of, look, they were underwriting deals in 15, 16, 17. I think they thought they'd exit stuff 10 to 12 times revenues, and they bought the best assets, and they maybe paid 20% higher to get access to the best assets, and then multiples went to like 20 to 30 times. The best way, by the way, to 4x your money is 2x your revenue and 2x your multiple. By the way, the reverse happens too. So, that's what's happening to all the stuff in 2021 vintage funds. Like, multiples got cut in half for people. And so, like, if you 2x your revenues and half your multiple, that's called a 1x.
What is the stupid stuff that we are doing today that not many people are talking about? We mentioned 21 stupid stuff.
Paying 100 times revenues for companies. We like to ask ourselves when we look at businesses. If I invest today and I grow it for 18 months, and I assume, like, it's still growing fast, am I like kind of in the money? Or do I need to grow for 4 or 5 years until I even get in the money? Like if you're growing, like I think in Toast, for instance, it was like when we invested in, I think it was in 16 time-ish, 17 time frame. It was like 25 of revenue, growing 250% a year. Like what would that would be $1 billion plus exit. That would be $1 billion and a half dollar multiple today, valuations today. We paid 20 times revenues. It was like $500 million valuation. We're like, that's pretty expensive. Then we think about it, we're like, okay, in a year from now, we're in it probably 10, we're in it at like 10 times. Okay, like for that growth rate, that's like saying it's pretty reasonable. Like I think I encourage people to ask, like, okay, if I pay this price today, in 12 months, am I in it still at like 80 times revenues or 50 times revenues? The prices being paid are totally insane. I also think not enough investors. I've had numerous entrepreneurs tell me, oh, I don't look at gross dollar retention. Net's the only thing that matters. And it's just like, oh, really? Okay. That's like I think more investors need to focus on like gross dollar retention.
Why so?
Okay. If you've got a business that ended 2024 at 10 million of revenue, and you say I have, and I've got 90%, and I've got 50, and I've got 200% gross dollar retention. So like, okay, my 10 became 20 all through existing customers, but you only have 50% gross dollar retention. You actually lost half your customers, and you had a few that really liked it, but that means a huge amount of it are like experimental. Now the problem when you're a really small company, a difference between 90% gross dollar retention and 50% isn't that much because it's not that much of the pond to fill up or the bucket to fill up. But when you get to like 100, 200, 300 million of revenue, like it results in, it's a huge hole in the bottom of the bucket, which just then leads to sales and marketing efficiency. It's just awful when your burn rates are higher. Not enough people. And like we look at a lot of these tons of these AI software companies, and like the gross dollar retention rates are just like really, really low. It's actually like shocking.
Pretty much all of them are.
There you go.
Not
every one of them.
Not every one of them. Lovable's got 85%, which is pretty good. It's better than ChatGPT.
But again, it's not 90 growth. By the way, we have a business in our portfolio. By the way, it will not change the world. It makes cardiac monitoring software. It is a very small market. It has 99% gross dollar retention. Like it just means that you can run the business very capital efficiently over time because you don't have to keep spending money on more and more sales and marketing.
How do you think about that kind of capital efficiency and future dilution element when investing? As we said earlier, your Uber and your Alibabas, these are incredibly cash consumptive businesses. And now you found businesses which are incredibly cash efficient, lean machines.
Yeah. So Alibaba was very cash efficient actually. When we invested, it was $1 billion of profit. Actually, there may be less shares of Alibaba. I credit Josiah and the team at Alibaba has actually done the amount of stock-based comp dilution for a lot of public companies is totally crazy. Most people, including ourselves, over the last 15 years, massively underestimated the amount of stock-based comp dilution and dilution that we all took. Uber's was totally insane. We tend to, over the last few years, we've dramatically increased the amount of we assume 20-30% dilution, and if you're investing earlier, it could be a lot more than that. We have this what we call capital efficiency. It's Warren Buffett would laugh at us because it sounds kind of stupid, but it works. Are your revenues today greater than your historical cash burn cumulatively? Not raised. If you've raised 80 but only burned 20 and you have a $40 million revenue business, that's a great business. But we're looking for a 1-to-1 ratio or better. We just think it speaks to so many just qualities of the business. Like we were lucky to be investors in Benchling. We're still investors, which was when we invested, Benchmark did the early rounds. Thrive was an early investor. When we it was 13 of ARR, growing well north of 100% a year.
That must have been expensive.
It was, it was expensive. It was I want to say in the low threes. It was expensive. Now, however, the company had only burned $10 million. It had burned very little capital. And why? Because it had amazing gross dollar retention rates. And and the CEO was just he thought a lot about I know when it got to 20 million, it had not burned 20 to get there. they just value the value of a dollar. You now have a lot of entrepreneurs that just like to light money on fire. By the way, I'm not saying some of them will build amazing businesses. By the way, we have definitely missed businesses that were not capital efficient. It's just like it wasn't for us.
What business most sticks out to you with that in mind?
That we missed? Yeah. Snowflake, like massive. I mean, when we looked at Snowflake, it had like horrible gross margins. Like, but again, we looked at it at $500 million, and like we were completely wrong. Like just like 100% wrong.
How many businesses actually, though, have that perfect profile that fits yours? When you look at, as we said, your Ubers, your DoorDash is
we looked at it in past. Yeah. So like it's fine. Again, we're gonna miss stuff. It's fine. But again, we have a framework. Look, 100 out of 10,000 companies will meet all 8 criteria. Now, a lot of those hundreds, the valuations would be totally insane if you can even get in them, or if they even want to take money. Out of 10,000 companies, 10% will meet 5 or more criteria.
Now, with respect, we live in such an interesting asset class because it is one where the supply chooses the demand. In other words, the company chooses the source of capital in a lot of cases. And my question to you then is, okay, we find one that meets all the criteria. They then have to choose you. If they meet all the criteria, they probably have a lot of options. With absolute respect, Mitchell, you're not a romantic around company creation in the way that a lot of Silicon Valley VCs are, or the way other investors are. Do founders resonate with the kind of financial?
Founders so our pitch is very simple, and it's the reason that, a huge number of our founders have invested in our funds post-exit.
The founder of Duo responded and then DM'd me after I tweeted about having you on, being like, amazing. Now I'm an LP. It's even more amazing. It was cool to see.
So it's like, what do we do? Why is that? So when we started LeadEdge, my partner Nima and I, because Brian hadn't even joined yet, sat around and we're like, why is it we could take our 2 knuckleheads' money? Like, why are they going to take our money? And we were like, well, if we were the global head of HR if I had been the global head of HR at Pepsi, and Nime, you had been the global head of HR at Microsoft or Dell, pick a company, we could probably cold call HR software companies to be like, hey, let us invest in your business and we'll introduce you to a bunch of like global HR execs. And that'd be like probably pretty believable, right? We're like, we don't have that. We had never been the global head of HR of anything, or we had never done anything except like cold calling analysts. So we thought like, well, how are we going to get into companies? And we thought, let's make our competitive advantage be our LPs. So let's raise money. So let's raise money from world-class execs and entrepreneurs. And so like if you look on our website, 80-90% of our LPs get permission to be listed on our website. And these are people who run and have built some of the world's largest companies. These are people like the former CEO of Charles Schwab, the former CEO of Kimberly-Clark, the former CEO of Colgate-Palmolive. And we go to companies and say the following: if you invest with us, we'll give you access to our LPs who have built, run, and advised some of the world's largest companies. So, hey, you are a software company that sells into the pharma biospace. You sell R&D software. Well, hey, would you want to meet the former CEO of Pfizer? Would you want to meet the former CEO of Biogen? And by the way, we introduce them during our diligence process. They act as our own version of McKinsey. That helps. That's how we get into deals. And that's why people like us.
Great. Sounds great. Respectfully, that is a model, though, now that's used by a lot. I have, $65 billion founders in our funds. They're less kind of traditional company, much more software-led founders. But and I use that as a weapon, so to speak, to win. I would say founders are like, yeah, that's great. But by the way, Index have that too. And definitely Sequoia do. And all the great firms have this kind of armory or kind of weaponry of great entrepreneurs who are invested with them. To what extent is that differentiating?
A lot of ours aren't entrepreneurs. They're executives at like plain, boring, vanilla software companies. Or sorry, non-software companies. We just constantly leverage them. We make, we can track introductions. We track every intro. Everybody says they help. Very few people do. I think there's a reason that 80 plus portfolio company former and current portfolio company execs who we've backed are investors in our funds. So I don't know. Everybody says they help. Some people probably do more than others. We just do what we say we were going to do. It's just not that hard.
Dude, I love it. You said about tracking intros there. You had a very viral tweet and I can't remember who did it. I think it was Pit Desi, Shil Monat, who kind of tweeted your like criteria around how companies do reporting.
The hierarchy of bullshit.
Yeah.
How CEOs lie to us.
Yeah, but we'll go into how CEOs lie to us. But one of the ones where when funds like, are fudging numbers, they track intros.
What? So like, look, we are, we believe, so like we can give, there's a reason that Doug Song, who sold his company for $2.5 billion, put money with his fund, because we drove tons of intros. There's a reason that VCs, some of the biggest venture funds on the planet, are longtime investors with us. They've seen us in action do it. I don't know why more funds that like say they have these incredible networks don't help people more. Like I have no idea why. Like I mean, I have a feeling a lot of funds
Scale.
It's scale, and also a lot of people are just like a lot. So a lot of our LPs are execs who are plus or minus 5 years away from retirement, 10 years, they've been retired for the last 5 years or they're about to retire in the next 5 to 10 years. And they want to help. Like a huge amount of our LPs are not from Silicon Valley. And so we find them a company and we get them involved early on in the process. I mean, it's how we do diligence. And so if like you are a payments company, like we invested in TransferWise over here, we very early on before we invested said like, listen, would you want to talk to the former CFO of PayPal? Would you want to talk to, the former president of Visa? And any good entrepreneur is going to be like, yeah, that sounds like interesting people. And then we call them and ask them, hey, what'd you think?
How do you manage that from an infrastructure perspective? Because that sounds amazing, but it's difficult.
It's a lot of work.
Yeah, it's difficult to coordinate.
So look, every intro we make, I wish I could tell you that it's automatically logged. No, we BCC an assistant and it gets logged in Salesforce. It's a highly customized version of Salesforce that, we've spent millions of dollars on customizing over the last, 15 years.
Do you have like heads of network and network managers and community managers?
We do not. What we have is every person, if you work at Lead Edge, like every person on the investment team has access to all the LPs. And by the way, to be clear, if you're an associate who's worked here for 2 years or a year and a half, and you're going to Seattle for a wedding, and you say, hey, I want to stay on Monday, we'll be like, wonderful, you should meet like these 4 LPs. We'll pay for your plane ticket. Like we encourage everybody that works at the firm to get to know our LPs, spend time with them, educate them on what's going on in the portfolio. Versus if I was like a vice president I'll pick on Index, but I can pick any firm on the planet. If I was a vice president at Index and I was flying to Seattle to meet a company, I would go meet the company. I'd go meet maybe another prospect company, and then I'd fly home. I wouldn't be spending, 6 hours meeting 4 other individuals and like who are LPs in Index. It's not their model. It's like these funds are primarily backed by the largest endowments and pension funds in the world. And our model is like, we're going to be 95% backed by individuals, and we're going to treat those individuals like gold. And so we're going to communicate with them. And yeah.
Quite a lot of VCs today say that founders are our customers. LPs are not our customers.
Well, I would tell you that we have 2 customers, founders, but more importantly, LPs. Because if you do not have LPs, you do not have a business.
I 100% agree. I think it's really arrogant to suggest that they are not your customer. I think there's 2 customers, as you said, founders and LPs, but I'm astonished by this unwillingness to recognize them as customers that we have to provide a great product for.
So like we run our business trying to figure out how do we have 97%, how do we keep up 97% gross dollar retention, not net, gross, with LPs. So like if you think that, what do you do? So we communicate with them. We do lots of events with them. We do quarterly calls. We walk people through the portfolio. We tell people how things are doing. Look, some companies are going to be doing well one quarter. Some companies are going to be doing bad one quarter. But again, when you grow 30% a quarter on average, like some are going to be doing well, some are going to be doing bad. But just like the lack of transparency in this industry to LPs is shocking.
To what extent do you think your re-up rate is determined by your engagement, community, communication versus performance?
It's both. By the way, without good performance, you can have none of it. But I can tell you that here's the thing though. People want the nice guy, the good guy, the person who communicates to win. So like if you have a bad vintage or 2 bad vintage funds, they're more likely, I think, to stay with you.
100%. And that line's not dots again. You said there, they won't come back without the performance. Wrong.
They do come. By the way,
they do. We've seen.
By the way, there are. I'm not going to talk about. There is a very well-known, very large private equity fund that would historically would raise their, it's not in software, would raise their funds and literally be like to LPs, you have 3 weeks to get your docs in. Take it or leave it. These are the terms. We're not changing anything. They then had a bad fund vintage. They've been in the market for 3.5 years. The fund they just closed is like a fraction the size of their fund before. And I asked him, LPs, what's the problem? He's like, you know exactly what the problem is. They're jerks. But it's like, it's just your LPs, like they give you the money. Like without you, they're paying you. Like it's, I don't know.
I get you, but we've seen a lot of fund like returns or performance numbers leaked in recent months. I'm not going to name the funds because I don't want to bluntly pick them out. And their numbers have been poor, to be blunt. Mid-teens IRRs at best.
At best.
For early stage funds. And they have scaled AUM and had a excess supply of LP cash. Is performance even relevant?
That's why LPs are to blame too, for a lot of this. Like
I have many LPs come in this office and say, hey, Harry, I have 500 million a year. Where do I go? And I say, well, we go to these tier ones, but you can only get 20 in each.
Yeah.
And so there's 100, and then they have 400 left. And they go, so see, I've got to put 75 in X multi-stage firm.
Yeah.
I just have to. It's my budget.
So what I would be, then like, the smartest ones I find are actually like, listen, if the opportunity is not there, let's go figure out where else to put it. Like, it's not like I have to put $1 billion in venture every year. Maybe $1 billion in venture is too big. Like I should be doing smaller. I think, look, I think like there's a guy, Eric Seabush at Mercer, who runs research there, who took a bet on us very early on. Before Fund 3, people would like laugh at us. Actually, our first institutional investor in Fund 2 was University of Virginia. And like, we literally started the meeting with like, you're not going to invest with us. Like, why would you invest with us, knuckleheads? Like, we don't have a brand. We have nothing. And a lot of the investment consultants really are very brand name focused. It's like, again, you don't get fired, you don't get fired, hire an IBM, hire McKinsey. I credit this guy, Eric Seabush, with like taking a flyer on us very early, and he's done it with a bunch of other young managers. And it's just all about the people. Like, and he like digs into, okay, I'm in your Fund 3. Why'd you exit these things in Fund 1? Like, how'd you think about it? How do you think about returns? How do you think about treating LPs? Talk to a bunch of like, talks to a bunch of like portfolio companies. Like, how do you actually add value? We tell LPs, prospect LPs, by the way, everybody tells you they help companies. Wonderful. Let me go introduce you to 10 companies in our portfolio. Call them as many people as you want and ask them if we add value.
Do you know what I actually just do? I just put screenshots in decks of like introductions to amazing people between them, and you see the response. It's like tangible value.
Yeah,
it's
for
like
sure.
Great, easy, totally get that. But respectfully, when you look at someone like Andreessen, they have proven that brand is more important than performance at scale.
Let's see over the next 20 years. Let's see over the next decade what happens. But you're right. By the way, they're far richer than I am. So
does that make you change your perspective on the importance of brand, or you just go, fuck that, we stay in our lane and we do that?
We stay in our lane. So I have a huge amount of respect. There's this amazing...
is your sorry, I mean this so nicely. Is your ego a little bit hurt because your performance is here?
Nope.
But people don't...
No. But I respect a firm, probably one of the best returning funds in like the tech investments. There's a couple of them. One of them is Spectrum Equity. Incredible investors. They've kept $2 to $2.5 billion funds forever. By the way, Benchmark. Funds are smaller. Now, Benchmark has had like, what's incredible about Benchmark is it's like you had Gen 1, Gen 2, now you have Gen 3, and they still continue to put up really good numbers. They've kept it small. Josh Koppelman at First Round has continued to stay small. Mike and Ann at Floodgate have continued to stay small. But the firm that I think has generated the best returns in the tech investing world over the last 30, 40 years, and it's become more a buyout fund, but they used to do tons of minority, is TA Associates. And it's gotten gigantic, huge funds, but the DPIs that they put up are just like incredible. But Spectrum
What do you think they do that makes them so good?
They're relentless in thinking about how to get liquidity to LPs. So a lot of stuff they do in the buyout world now is like they'll do minority sales. They'll invest in a company 2 years later, sell 30% of the company to somebody else, get their bait back. So they're sitting on already a 1x. Like they're just like relentless focus on liquidity. I think some of these not even multi-strat funds, like these giant platform funds, the Andreessens of the world. There's just so many people at these firms. I have no interest in having like hundreds of employees. Like, we have 80 employees, and that's plenty.
Do you think venture? Doug Leone said on the show to me that we've moved from a boutique, high-margin community to a commoditized, low-margin industry.
100% agree with him.
Do you think that is irreversible? Is the platformization now venture? It has matured to this asset class.
Is it reversible?
Because the hard thing also for me is the cost of capital is so different. So I lost a deal recently to one of these large multinationals. I did 3 on 15. Handshake with the founder. It was pre-product, pre-revenue, pre-everything, but an amazing founder. And he called me up the next day and he said, I would never walk out on a handshake, but I got offered 8 on 100 and it's uncapped.
Yeah. Look, these bad returns will do it over time, but it's going to take a long time. I think the venture industry was about to be in for a rude awakening, and then AI showed up.
I always say AI was the OxyContin that we needed.
Yes, I think that's for a lot of these venture funds, I think that's true. Again, I've talked to a lot of legends in this industry. I love to talk to people that have been in this industry longer than I've been alive, or investing we're adults in the 90s or the 80s. What's going on in AI looks very similar to the internet bubble, or and it's like people didn't learn a damn thing from 20 and 21. It's shocking. I just... By the way, let's not even talk crypto, because that's a whole nother world.
Specifically, what should we have learned? Entry price matters.
A lot.
Don't overcapitalize companies.
Bingo. Yeah. Entry price matters. Don't overcapitalize companies. The amount of stock dilution really, really matters. If you run a fund where you need IPOs, you better invest in founders that want to IPO their companies, or have a good plan how you're going to get a lot of secondary out of it. But it's entry price matters. Entry price matters a ton. These companies are not all Snowflake and Facebooks. They're not. The vast majority of companies, I put on one hand the amount of people that are capable of backing companies like Googles and Facebooks of the world and doing it more than once. It's a really, really, really small group. It sure as heck isn't me. It's like the Doug Leones of the world, and there just aren't many of them.
I love Doug.
No, it's just we need more Doug Leones and Don Valentines, and and people that are just and LPs that are very direct and outspoken. People like Peter Dolan at McKenna, who used to be at Harvard, and
if you would, we have hundreds of thousands of listeners and several thousand LPs.
Yeah.
If you were to advise them something on investing managers today, it can be anything. What would you say?
I believe a great question that people don't ask that they should ask. Any manager who's been around 10 plus years. Hey, in September 30th of 21, how much unlocked stock did you have in your portfolio? And let's say September, that was the high point of the insanity in the last, tech run up. How much unlocked public stock did you have in your portfolio? And the next question is, why didn't you distribute it to your LPs? And by the way, a lot of funds can distribute stock too. And you could have kept the stock. So why didn't you hold? Some people will be well, I was on the board. Well, shouldn't you, isn't your goal just to return returns to LPs? Isn't that the whole job of the business? But I don't know.
That would be a shocking amount of people that have a lot of unlock that did not return.
Did not return money. Look, I also think LPs should spend more time talking to companies of portfolios that failed. Actually talk to the ones that didn't go well, or were the 1Xs, to find out what is the person really like to work with. The ones that work really well, those are the easy ones. But it's what actually tell me the stuff that didn't work, and how was the partner on the deal? How did they respond? How did they deal with adversary? How did they deal with you? Hey, those are the things I like to focus on.
You said, hey, if I get the chance to take a 0.7x back on an underperformer, fuck it, I'll take it all day long. All day long. How do you feel about the transactional nature of where time is spent? You're Fred Wilson's of the world, who is an incredible investor.
Incredible. He'd be in that 5. Yeah.
Of course, completely agree. But he always says reputations are made in the bad companies. And then you also have the realization that I have a limited amount of time and I have to manage a portfolio and invest in new companies. Is it possible to bluntly cut your losers elegantly to concentrate on your winners?
it's a lot easier for me to do it than it is for Fred because he was there when it was nothing. And I came in as it was a bigger company. And so, but again, there I think are some VCs that are like world-class VCs that cut their losers. And I think there's some of, or like cut, like there are firms that are known. There are firms that are known to if you're a CEO and you don't perform, you probably won't be the CEO. But like, I think if you're just the founder coming in, you should just be. Well, I have no problem. I tell all my employees if I'm not the right person to run Lead Edge, like throw me out. Like that's fine, or put me on the side. You come and run the business.
You mentioned ByteDance earlier.
Yeah.
We had the head of privates from Bailey Gifford actually in yesterday,
Cool.
who are big in
Yeah.
ByteDance. There is a lot of public concern in the US or excitement, whichever side you sit on, that TikTok will be shut down or kind of divested. You said before you're not worried about that.
So when we underwrote ByteDance, we assumed the U.S. business is worth zero. ByteDance North America is a single-digit percentage of revenue. We assumed it would be shut down, and it's not profitable in the United States. Then we saw actually what happened when they shut it down for a day, and both sides of the aisle came running up with their bags saying, "Oh, please keep it open. Please keep it open. Please keep it open." We just want something to happen. Either shut the thing down for good or spin it off or do something. I suspect it's not done by April 5th or whatever the date is. They'll probably push it out. Again, I'm not saying I just don't know. I think there's 4 or 5 people in the world that don't know what's going to happen. And time will tell. But again, it's like just the uncertainty. I do think this, though, that the Chinese government actually really likes ByteDance. It's a truly global business. Alibaba is not a truly global business. Tencent is not really a truly global business. Nike is a truly global business. Microsoft, John Deere are global businesses. What I mean by that is you can go into, 140 countries around the world and buy Nike shoes. Probably go into 100 countries around the world and buy a John Deere tractor. China's always wanted to build a truly global business. This is that first truly global business. Like, if you think they're just gonna let other, I think that they're very proud of what they built, and it's a huge business. I think they're going to be one of the foremost AI companies on the planet over the next decade.
What makes you say they'll be one of the most foremost AI companies?
I mean, the amount of tech. I mean, there's a reason when the amount of AI they have already embedded in the product. I mean, in India, when they were kicked out several years ago, nobody's really been able to build a competitor in India. I mean, Facebook's trying. By the way, who hates ByteDance, right? Mark Zuckerberg. And by the way, so would I. To be clear, I would be, if I was running Snapchat or Instagram or Facebook, I would be all over politicians in Washington being like, "Oh, this is horrible. This is all propaganda. This is you got to get these guys out of here." It's the biggest threat to these companies. It's absolutely incredible what the Chinese have built. The Chinese are if you look at all these stats, like number of PhDs and science spend and all these things, it is an incredible country that is they're not worried about what happens next quarter or next year. They think in 50-year blocks.
Do you think we as the West underestimate China's ability in AI?
100%. I just have seen how hard people in China work at some of these tech companies.
I agree with you, and as a result, I get concerned. Do you get concerned by their ability to infiltrate our societies and provide amazing products, but
I think both countries should learn to get along. China and U.S. collaborating together more is better for the global world than less. There's lots of things both countries can do together to make both countries a better place.
Peter at Bailey Gifford taught me actually the strength of the core ByteDance business in China. I know it's a global business, as you said, but the core business in China, monster.
And by the way, it's a huge e-commerce business there too.
Unbelievable. But
yes.
we all think TikTok shutting down in the US, it's over, it's terrible. And not really at all, actually.
Yeah, exactly.
My question to you, though, is if it is more domestic focused, I just don't understand where liquidity comes from. It is not going to list in the US, clearly.
Hong Kong, for sure. By the way, Tencent's listed in Hong Kong. It's gigantic. Hong Kong, 100%.
And that's feasible. I'm naive here.
Oh, 100%. Yeah, but Tencent's a huge company. You can list, there's giant Asian businesses listed on the Hong Kong Stock Exchange. Yeah, it's very liquid. You could have $1 trillion. By the way, I don't know what Facebook stock is, market cap is yesterday, but I think it's a $1.5 to $1.7 trillion company. This is the same size. business in terms of earnings. Grows faster. I mean, like Alibaba and Tencent don't really grow that fast. I mean, they're like 5, 7, 8% growers. What do they trade at? 13, 15 times earnings? Like, you do the math. Like, this is a very, very big company. We like to buy stuff when no one else likes to buy things. Like, when the world hates something, one of my longtime LPs...
Does that not go against your statement, though, of the best founders are not the ones calling you back?
That's fair. That is a fair statement. I just think that if you... Not always, right? Like... But
because I struggle with that statement too, because I have so many great entrepreneurs in here, from the founders of UiPath and the founders of Klaviyo, and like go on and on and on. Toby at Shopify, he just gives me, dude, I have like 50 VCs were like, nope. And actually, it is the opposite. They were calling.
Yeah, look, for every Toby at Shopify, there's 100,000 founders that are like, that aren't going to make it. But look, it's incredible what he built.
Yeah. Can I ask, final one before we do a quick fire? What's your favorite deal? You've done many deals. What's your that's my favorite. What did you learn from that?
I mean, Duo was a really interesting. I mean, it depends on like favorite deal is buying like LPs out of a 20-year-old fund and buying something to like get 4 times earnings. I mean, find something like at 4 times earnings. Like.
You buy fund positions?
100%. So like this...
Wait, you do strip sales
Yeah, so let me explain.
Yeah.
So the company I'm going to get to is this company called WorkHuman. That's where we're going to go with it. There's a table in front of us, right? Yeah. Let's say this table is a company. If I buy 10% of this table or 60% of this table, it's the same table, right? Uh-huh. If you own the table... But the chair you're sitting on, and if you're the fund and you own the table, and the chair you're sitting on owns half your fund, and I buy the chair, I just bought 25% of the table. So like we just view it as like buying it to a wrapper. So we describe investing in companies as we have these like very specific criteria, and then we take this completely flexible approach. We'll buy 10% of your. We'll go through the front door. We'll think of like a house. You're walking down the street, you see a 3 criteria house, walk by it. See a 4 criteria house, walk by it. Get to a 6 criteria house, knock on the front door. You can go in the front door and you can lead around in a minority deal. You can go in the front door and buy the entire business. Well, let's say like they don't want to raise capital. You can go in the side door and buy out like an early investor or an early employee in the form of secondary. Again, it's still the same house. But let's say like that doesn't work. Let's say like you can't buy secondary. So for a whole host of reasons, it could be ROFRs, it could be there's no sellers, whatever. Well, let's go through the basement window with a pickaxe and let's find a derivative. Let's fund somebody's co-investment vehicle. Let's find some 20-year-old fund where 90% of the NAV is in like one company. So this example, this company WorkHuman is an awesome business up in Boston. It's been around 20 plus years. It's insanely profitable. And it doesn't grow 50% a year. It's a giant stable business. I'm going to totally get dates wrong, but like it came out of like we met the company. There was nothing to do. There was no like, the company didn't need primary capital. It was super profitable. There was no secondary to buy. So we found an old fund that was 17 years old, and we went to the founders and said, look, the fund you must have like a bunch of LPs that want out. You've been in it 16 years, right? I mean, we bought it at like the position at like 5 times earnings. And we've gotten 90% of our money back through dividends in the company. And you're like, well, how'd you do that? The LPs were in the fund for like 15 years. They just like wanted out. So
there are these unique opportunities I find in business where it's this arbitrage on timing.
Correct.
And that is the most special time ever when you have a manager who desperately needs liquidity to get a fundraise. And they know that it is inopportune to sell, but they need to get that next fund.
Correct.
And for you, your duration is different.
Correct. And so we were like, in a world where LPs and GPs are looking for liquidity, fishing in the pond of old funds, like 20-year-old funds, people are like, well, what's your discount to NAV? I'm like, NAV's irrelevant. What's fair market value? If like NAV is really cheap, I'll pay you 100% over NAV. But I can't do that because then the LP would think, oh, you know more than I do, so I'll pay a discount to NAV still.
Do you worry that everyone is doing that now?
It shocks me that more people don't do this. There's not that many people doing it. The secondary funds,
Because they do gauge, like, gauge your eyes out on price.
A lot of people are going after the multi-asset stuff. So you'll buy, an LP that's selling 30 positions in 30 old funds, and there's 200 underlying companies or 500 underlying companies in it. We're looking for the stuff where there's like one underlying company, and like it's an old fund, 90% of NAV is in one company. And like we just write off the other stuff. Basically, I just like look at it.
Got you. So you buy the basket, discard the 10% that you don't want.
Correct. Yeah. Exactly.
Got you. Have you ever been surprised on the 10%?
Yes, we got back 50% of our money on a 10% in this fund, and we're human. Yes, it was some like chips company that literally were like the cash balance on the balance sheet is like almost as big as their valuation for the entire company. Like this doesn't make much sense. Like I don't know what this thing does. Whatever. Maybe we'll get something back. Yeah, we got 50% of our money back.
Wow, I love that.
Yeah.
Listen, I want to do a quick fire. I've so
Sure.
enjoyed this conversation. Okay, so let's start with, where are we? What do you believe that most around you disbelieve?
I believe that like DPI is the most important thing, and marks are completely for suckers.
You can buy and hold one public stock for 10 years.
Microsoft.
Why?
The pricing pressure, the pricing power they have is just absolutely incredible.
You don't worry that there's no upside left given how richly priced they are.
It is expensive, but like it's just an incredible business with amazing price power. I think they have so like you asked me who I thought was the best CEO I saw on that list. I think Satya is an absolutely incredible CEO. It's a giant business. There are companies in like a downturn. If we could get a 30% drawdown, like I would buy Snowflake or buy Datadog and put it in a drawer and let those compound for 10 plus years. I mean, Amazon you could put in that bucket too. Just a lot of them are fairly rich stock.
What's the hierarchy of BS that companies report?
Like favorite place to work. If like on the second page of your like presentation, if you're like, we're the greatest place to work, in this region. But a lot of it comes down to like, they'll be like, oh, my revenues are this. You look at the chart, you start doing all the analysis, and you're like, actually, that was your total contract value. That's a pretty good one too. Like, there's a lot of ways to fudge gross profit numbers, and through COGS and all that kind of stuff.
What have you changed your mind on in the last 12 months?
I was probably even more skeptical about AI. Oh, self-driving cars, actually. Self-driving cars.
What have you changed?
I went for rides in them. Incredible. Now, it's going to take a long time to get out there. Now, 10 years ago, I said, like, people always underestimate tech over the long term, but they overestimate it always in the near term. Everybody was talking self-driving cars 10 years ago. The experience that I had in LA and like San Francisco in a self-driving car is absolutely incredible.
Now, we don't shit on people in this show, but we can praise them. And so if you were to choose one seed firm, one Series A, and one growth to put your money into as an LP, which firm would you choose?
If I had to be like a traditional growth, like Spectrum would be the growth fund, but that's a lot of your audience is not that type of growth. That's more like bootstrap growth. Traditional growth, either Iconic or Meritech. Like the returns of Iconic are freaking amazing.
Iconic or Meritech, Series A?
Those two groups, between seed and A, it would be like Benchmark or Bessemer.
You don't worry fund size is too large?
If you need to own a large fund and write a $50-100 million plus check, like I think Bessemer is as good as any that are big funds. Like I think the guys at Index are amazing investors too. Problem with a lot of these funds is you got to buy the basket. Like Bessemer actually just has one fund, which I highly respect. I mean, I guess they now have a buyout fund, but like and an India fund, but like.
You always have to buy the basket. You want to do Excel, you got to do
the whole basket.
You want to do Sequoia, Doosh. Totally agree. Sorry.
Oh, go ahead.
No, please.
Oh, I thought you were going to ask me like the short. MicroStrategy is totally insane.
Why?
I mean, I'm very not bearish on crypto, but like I think it reminds me a little bit of the tulip craze, that you can't actually use crypto to go buy like when you could. If I could go buy a Tesla with crypto, it'd be amazing. If I could go to Amazon and use Bitcoin, it'd be incredible. But like you can't right now. Now again, I think it's probably just so volatile. People can't like the currencies. The idea, like from what I understand, MicroStrategy is effectively issuing debt to go in the market and buy more, to buy more like crypto, and they just keep doing it. But if that reverses, eventually you got paid on the debt. I don't know, it just sounds like a house of cards to me.
What's the bit? Yeah.
But again, I'm not an expert on the company. I don't know. But like if that, it just seems to me like some of these like crypto businesses are a little skeptical.
Do you have any crypto investments?
I do not. No, I do not have any crypto investments. We've looked at stuff around the we looked at chain analysis years and years ago. Probably should have done it, like the picks and shovels type stuff. But look, should have done Coinbase like years and years ago. By the way, I should have bought Bitcoin too. I never have. Like, I mean, clearly I could have made a fortune.
What concerns you most in the world today?
Two things: income inequality, and that the fact that where I grew up in Michigan, I think I worked in a factory in high school. I think a lot of those people today are like basically way worse off relative to what wealthy people were, 25 years ago. And like if it's the 0.1% or the 1%, it's just like broken off, and this printing of money has just caused it's going to cause massive income dispersion.
I agree, but what happens, Mitchell?
It's
like getting worse.
That causes revolutions, to be clear. But the thing that I actually worry about more near term that's solvable is social media for teenagers. It's absolutely horrible. We need, but I am a ByteDance investor. To be clear, ByteDance in the vast majority of their market is highly regulated. Like kids in China go on TikTok to read about like science experiments and math projects. In the States, I assure you that's not happening, or in England. The media companies are regulated. There's a reason like the BBC or the Discovery Channel or NBC can't say a lot of the things that get said on social media. They're highly regulated. They're like regulated by the governments. You get massive fines. Social media companies need to be held accountable for the content. There's a law. I'm just forgetting.
Should we ban? Australia banned it for under 16s. Should we ban it too?
Yes, I think we should. I think it needs to be way highly regulated. By the way, suicide rates, depression rates, like all this bullying, all these different metrics you look at are going one way up and to the right. It is like the social media is the demise of society.
Penultimate one. When have you questioned yourself most as an investor?
I think we questioned our existence in 20 and 21 as like we were just getting annihilated on prices. We question ourselves now and are like, are we totally wrong on AI and we just don't get it? It's like, are there going to be one-person companies way sooner than we think? Are all of our software companies going to be completely disrupted and all of them go away? And like, I don't know. Like, I'm taking a stand that they're not. But like, I guess I could be totally wrong. I mean, I think any investor who says they know the answer to something, that's the best way to fail. And like, we just, you got to stay intellectually curious and just
my favorite is the theses that we say about. Every investor has a thesis, and what the fuck are we, professors? Like, I don't know about you, I've never had a thesis.
I don't have any thesis. Yeah. By the way, my thesis is this meets 6 or 8 criteria. I literally the amount of pontification in the world, especially on Twitter, by people that are like in the investment business, people should spend less tweeting, more investing time.
See, what you don't understand, though, is that brand is a hack. It's a hack to get LPs. It's a hack to get great founders. So, yes, I totally agree with you on the pontification. So, I think I love about our business, too, is like yours is 6 out of the 8. Mine is are they generational defining founder?
Yeah. By the way,
both work, which I love. Yeah, I love that.
There are 2 different ways to invest.
Which is awesome, though.
Yeah. One's not a right way or a wrong way. Here's what I believe. What you tell your LPs, just make sure you stick to it and do it. Yeah. That's actually the best advice I can give for any emerging fund manager. It's like, look, define what you're going to do and do exactly that, and don't stray from it at all.
Will the tourists get washed out of the venture ecosystem?
100%.
They will.
When? I don't know. It might be like a slow, hole in the canoe, but eventually, yes, they will. Yes, 100%.
Final one for you. I like to finish on like optimism, positivity. When you look forward the next 10 years, what are you most optimistic, positive, excited about?
The world, like humans are just like very resilient people that like adapt to change. And the fact that I'm glad I became a software investor and not an energy investor. Like, just because like energy, I don't know, it's been like a dying industry for the last 15 years.
But energy's never been hotter now.
It's hotter now, but like it goes in waves. And that's just like the amount of innovation that's happening and just like change. Like I get to meet really interesting founders. Some of them are going to change the world. Some of them are going to sell budget planning software to the Atherton Police Department. That's fine. But like they're building cool companies. Like, look, I am an entrepreneur. I was, when I went to Wharton Business School, I was involved in like the entrepreneur conference. And we'd always bring in people that like built software companies, built consumer companies. I was like, why don't we go get like Steve Cohen or like the guys who like built giant money management firms? Like Steve Cohen is an entrepreneur. Like he started with a very small business, started by himself, and now runs like one of the biggest hedge funds on the planet. Ken Griffin, same thing. I mean, like they're like incredible entrepreneurs, and like the ability I get to spend my day meeting cool entrepreneurs is just like, it's not a job. It's like an amazing thing to do.
You know, I hate the term operator and the way we use it because it implies that anyone else who's not like an operator, like you don't operate.
Yeah, exactly. Look, I've got 80 employees, so yeah.
Yeah.
Actually, the best advice I ever got, and something I try to do every year at Lead Edge, was from I got it from the founder of Excel KKR, which is a very good fund. And he said you should interview all your employees, from admin to your other partners, and basically ask them for feedback. Just be like, hey, if you were running the place, what would you do differently? You know, like, tell me everything you do in your job, green, red, or yellow. And so it's like, okay, well, I actually don't care what you do green. I care what you do red, because I want to get rid of those things. And like, I've been doing that for 3 or 4 years, and the feedback you get is just like incredible.
What have you most changed on the back of those?
So lots of things, but I would say the biggest thing we did is as we started to call more and more non-Silicon Valley based companies, our 18, 20 associates, 22, 24-year-olds were like, dude, in Chicago, nobody knows who we are. In Indianapolis, nobody knows who we are. We need to like get the brand out there. So we hired this amazing head of PR comms, Michaela, and who had helped build Tusk Ventures for Bradley, who had, by the way, built a pretty good brand over like a couple of years. And we're like, hey, Michaela, how do we get entrepreneurs in Madison, Wisconsin to like know who we are? So like, we've got 15 years of quarterly letters about like the hierarchy of bullshit that, by the way, other venture funds take viral.
It's a book.
It's a book.
I'm reading it.
We literally have a 400-page. By the way, it makes a good doorstop, good kindling in the winter for a fire.
But it's really good.
So that content we want to start to release to the public. Like we joke that's like, it's very funny that partners at Andreessen Horowitz, who we're friends with, or partners at Benchmark, or partners at, First Round, have made the hierarchy of BS letter kind of famous. Like we didn't actually make it famous. We just gave it to other people who distributed it. Like we should distribute our own content. Yeah. And so like, she's like, we have 10 years of amazing letters like this, 15 years. Let's start to like put those out there, go on CNBC, like go on Bloomberg, and look, entrepreneurs, if you're on TV, that you're now smart. But again, it's just, we tend to like be a pretty like direct firm. And like, actually, another thing that we pride ourselves on is fast no's. And I don't think enough people do. Tell an entrepreneur if it's not a fit. Tell them very quickly. Don't waste people's time. Like people, by the way, I'd say it to LPs. If we're not a fit for an LP, please tell me. There's no reason for me to meet you 2 or 3 times and give you a bunch of data. I highly respect you have a call with somebody and they're like, you know what? Like what you do, Mitchell, you guys just aren't a fit for us. No problem. Like we at Lead Edge, to all our analysts and associates and principals and VPs, like drive down the fact that, hey, you talk to a company, like they've prepped for the meeting, they've done a bunch of work, tell them it's just not a fit. Like don't drag it out a month. Don't drag it out 2 weeks.
Do you give them the reasoning why?
100% we do. Yes.
And you don't worry that they'll argue back?
Don't care. It's just like some people do argue back. And by the way, this is amazing. We passed on an analyst candidate. I mean, I wasn't involved in it at all. He emailed me and said, hi, I'm on like the Harvard, varsity team of this and this. They know we like athletes. My rejection box is full. I reject your rejection. He got another interview. So like I was like, this letter is just like incredible. He actually, like, most people get rejected, then like 99.9% of people get rejected and you never hear from them again. This guy was like, no, I reject your rejection. Here's the reasons why I think I'd be really good. Here are some really interesting companies that I think are interested in. And I'm like, this guy sounds pretty damn good. Like, why did we pass on him? They're like, oh, well, we're kind of full for the year, and get him back in. Like, let's meet this guy.
The thing I find astounding with people who want to get into venture is actually it's quite easy if you just give the freemium version of yourself. If I send you 3 companies every quarter that align to Lead Edge's model and the companies that you like, and I can see that on your website, and I do that for 3 quarters, say 9 months.
Come in here. Come and talk to us. 100%.
100%.
Yes.
Like, yeah, that's impressive.
Yes, 100%. Yes.
Listen, Mitchell, I've loved doing this. Thank you so much for joining me, and you've been a fantastic guest.
Thank you.
Amazing, dude.
Appreciate it.